On August 4th, 2026, Advanced Micro Devices reported the single greatest financial quarter in its 57-year history. Every metric that actually mattered was an absolute blowout. Revenue? Up. Margins? Up. Their core data center business? It literally doubled. And yet the smartest money on Wall Street looked at those record-breaking numbers, slammed the sell button, and triggered an instant, brutal sell-off. So what exactly is going on here? What does the market see hiding just beneath the surface of this historic earnings beat? Let's just look at the sheer scale of the disconnect for a second. Going into earnings that day, the market was pricing in absolute perfection. Pre-earnings optimism had pushed the stock up over 5% in regular trading, hitting an intraday high of $518.58. But man, the moment that earnings release hit the wire, the tone violently shifted. The stock completely cratered, dropping 8.69% in extended after-hours trading and settling down at $473.53. That is almost $45 of value wiped out in a matter of minutes. And here is the real paradox of the whole situation. They didn't just meet the street's estimates, they completely demolished them. Q2 2026 net revenue came in at a staggering $11.536 billion. That's a 50% year-over-year explosion. Non-GAAP earnings per share hit 166, easily beating the analyst consensus of 161. Even non-GAAP operating income grew by 245%. So if the numbers are this pristine, why the sudden punishment? Well, to understand the fear, we first have to understand the economic engine.
Section 1. The Economic Engine. Inside AMD's Data Center Dominance.
For a really long time, the dominant narrative around AMD was that they were just this scrappy consumer PC and gaming company, forever playing second fiddle to Intel. But you know what? That narrative is entirely dead. Today, AMD is a foundational pillar for hyperscale cloud providers and AI labs. We are talking about the absolute titans: Microsoft Azure, Amazon Web Services, Meta, and Google Cloud. These mega-cap companies aren't buying $300 gaming chips from AMD anymore. They are buying $10,000 computing infrastructure. We're talking server CPUs and AI accelerators that literally power the future of generative artificial intelligence. Just look at exactly how massive this shift has become. The data center segment didn't just grow, it more than doubled. That is 107% year-over-year growth, pulling in $6.7 billion in a single quarter. The data center alone now makes up over 58% of AMD's total revenue. Meanwhile, look down at the legacy gaming segment. It actually dropped 31% year-over-year to just $779 million. AMD has successfully shed its past. They are rapidly becoming an AI data center pure play. Now, to grasp why they are winning these massive hyperscaler contracts, we have to look at how they're competing against Nvidia. Historically, the dominant player in AI relied on proprietary software lock-in. Nvidia's CUDA platform is a closed ecosystem. If you buy their chips, you have to use their software, which of course gives them immense pricing power. But hyperscalers like Meta and Microsoft hate being locked into one vendor who dictates their margins. So AMD is taking the exact opposite approach. They are building a moat through open source software, specifically their ROCm ecosystem. By partnering with frontier AI labs like Anthropic and OpenAI, AMD is making it seamless for developers to natively optimize code for AMD's Instinct GPUs without being trapped by a single vendor. And they combine this open software with their highly efficient chiplet design architecture. See, instead of manufacturing one massive, expensive, monolithic chip where a single microscopic defect ruins the whole thing, AMD manufactures smaller chiplets and essentially stitches them together. It is a massive manufacturing cost advantage. They are giving the biggest tech companies in the world a highly profitable, scalable escape route from single vendor lock-in. Which brings us to the sheer size of the prize they are chasing. At their Advancing AI 2026 conference, management updated their total addressable market, or TAM, for the year 2030, and the numbers are just staggering. A $1.4 trillion market for AI accelerators, $200 billion for server CPUs. When you add in high-performance computing, it's a $2 trillion opportunity. But why is it so big? Because the industry is structurally shifting from AI training to agentic AI inference. Think of it this way. Training an AI is like having it read the entire library. It takes a lot of effort once. Inference is the AI actually taking the test, answering questions, and executing tasks in real time. Agentic AI means software agents that don't just chat, but autonomously run billions of complex multi-step queries in the background, 24/7. That shift requires unbelievable compute scale. It structurally requires both the massive memory bandwidth of AMD's Instinct GPUs and the orchestration power of their EPYC server CPUs to manage the traffic. Section 2. The Central Conflict. Why Wall Street Sold the News. So the business is fundamentally firing on all cylinders. They're taking record x86 market share away from Intel, pushing past 33% in servers. Their TAM is exploding, and they just posted an incredible top and bottom line beat. So we're back to our central question. If revenue is up 50%, why did the stock instantly drop $45 a share? And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Anyway, the sell-off ultimately comes down to two major structural fears hiding just beneath the surface of that pristine earnings beat. The first fear is what we call the Helios margin squeeze. In Q2, AMD's non-GAAP gross margins hit a very healthy 56%. But to compete at the absolute highest level in data centers against Nvidia's newest systems, AMD is no longer just selling individual chips in a box. They are ramping up early-stage mass production of their new Helios rack platform. This is an unbelievably complex piece of heavy industrial equipment. It integrates 72 GPUs, 18 CPUs, and literally miles of custom copper and optical networking, all into one massive rack. The physics involved here are staggering, requiring intense liquid cooling and drawing massive amounts of power. If even one single node or connection fails during assembly, the entire rack faces integration issues. Wall Street is terrified that the sheer manufacturing complexity, the integration failure rates, and the early-stage deployment costs of building these supercomputers will severely compress near-term profitability. They fear that 56% margin might be a peak, not a baseline, as the cost of goods sold skyrockets to support the Helios rollout. The second major fear is the wall of external competitive threats. AMD is fighting a multi-front war right now. Nvidia isn't just defending its AI turf, they're actively invading AMD's traditional CPU space with ARM-based Grace and Vera architectures, which already command a 13.2% server share. Then you have Intel, desperate and cornered, pouring massive capital into staging a manufacturing comeback with its advanced 18A node to reclaim lost market share. But perhaps the most existential threat long-term comes from AMD's own best customers. The hyperscalers, Google, Amazon, and Meta, are pouring billions into building their own custom internal silicon, like Google's TPUs and Amazon's Trainium chips. They want to own the hardware, to control their own costs. Wall Street is looking at this dynamic and asking a really terrifying question. Can AMD maintain its hypergrowth and premium margins if its biggest buyers eventually figure out how to build the hardware themselves? To really evaluate complex threats like these, you need more than just headlines. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is totally free. Now, if you want an ongoing investing edge, Flash is a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of the screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Section 3. The 5-year scenario framework. Now, before we dive into the math, I must clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. Just look at the sheer variance in these outcomes looking out 5 years to fiscal year 2031. These are the ultimate stakes of the investment, completely dependent on how the AI cycle plays out. The low case drops the stock to $134.23. The base case points to a solid $670.70. And the high case, that shoots all the way up to $1,842.87. When we apply probability weighting across these 3 fundamental scenarios, considering current market dynamics, the expected outcome lands right around $856.45. But remember, a target price is just a mathematical output. What actually matters is the operational execution required to get there. Let's walk through what actually has to happen for these scenarios to play out. For the high case of $1,842 to materialize, AMD has to execute flawlessly on multiple fronts. They must hit $239 billion in annual revenue, which means agentic AI demand remains insatiable and their open-source ROCm software wins broad global adoption. They also have to expand net margins to 30% by successfully driving down the manufacturing costs of those complex Helios racks. Finally, the market must award them a premium 38x exit multiple. A 38x multiple implies the market views AI as a multi-decade supercycle and sees AMD as an undisputed, permanent duopoly member alongside Nvidia. But on the flip side, look at the low case. This happens if Intel successfully stabilizes its market share, custom hyperscaler silicon eats significantly into AMD's demand, and an intense hardware price war squeezes AMD's net margins down to a painful 16%. In that world, revenue stalls at $68 billion. The market completely derates the stock to a 20x multiple, meaning Wall Street decides AMD is just a cyclical legacy hardware vendor again, and investors suffer a 74% loss. If you want to dive into the full model with all the detailed assumptions for each scenario, you can check out the free detailed research report at Flash.
Section 4. Risk Analysis and the Qualitative Scorecard.
So how do we evaluate the likelihood of these outcomes? Based on our research framework, AMD currently holds an 8.7 out of 10 blended qualitative score. The growth outlook scores a perfect 10 out of 10, entirely driven by that massive $1.4 trillion AI TAM, and their clear position as the industry's most credible second source. For advanced compute, management alignment scores a very strong 9 out of 10. CEO Dr. Lisa Su has heavy skin in the game, holding nearly 2.9 million shares directly, and 75% of executive equity compensation is strictly tied to long-term performance targets. But notice that business viability gets dragged down to an 8. Despite a pristine balance sheet, there is one massive, dark structural vulnerability that investors absolutely must monitor. We call it the TSMC choke point. See, AMD operates a fabless model. They are brilliant at designing chips, but they do not own the factories that actually print them. Their entire advanced node execution, including the critical 2-nanometer process for their future CPUs, relies on Taiwan's Semiconductor manufacturing company. But it goes much deeper than just the geopolitical fear of tension in the Taiwan streets. Wall Street is deeply afraid of a literal physical factory bottleneck. Advanced AI accelerators require a highly specialized manufacturing technique called CoWoS, or chip-on-wafer-on-substrate packaging. TSMC's CoWoS packaging facilities are finite, and AMD is fighting for the exact same assembly lines as Nvidia. If TSMC cannot build advanced packaging factories fast enough, AMD literally cannot sell more GPUs, no matter how high global hyperscaler demand is. It is a severe single point of failure concentration risk, and it's the geographic Achilles heel of the entire 5-year thesis. Section 5. The bottom line. Entering August 4th, the market had priced in absolute, uninterrupted perfection. But AMD is playing a highly complex, multi-year platform transition game. They have successfully executed a historic, definitive pivot to the data center, and their long-term runway in agentic AI is undeniably massive. But in the near term, the reality of physically ramping 72 GPU Helios rack systems, defending against ARM-based competitive incursions, and managing advanced packaging supply chain choke points means the road ahead will not be perfectly smooth. The verdict is this: the market didn't sell the company's long-term potential, it sold the near-term margin friction. The numbers were perfect, but the physical reality of building AI supercomputers is incredibly hard. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.sentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.